Welcome to our YouTube channel. In today's video, we will be discussing Lesson 7 Assets, one of the key components of the Statement of Financial Position and Statement of Owner's Equity. The Statement of Financial Position is also known as the balance sheet, shows the financial condition of a company at a specific point in time. It represents what the business owns and what it owes. This statement is based on the accounting equations. Asset is equal to liabilities plus owner's equity. Through this statement, users can understand the company's overall financial position at a given time. Assets are the resources owned by the business that provide future economic benefits. Assets are classified into current assets and non-current assets. Current assets. Current assets are assets that are expected to be converted into cash, sold, or used within 1 year. Examples of current assets include cash. These are the coins, paper bills, checks, and money deposited in bank. Cash equivalents. Short-term investments that can easily be converted into known amounts of cash with very little risk. Marketable securities. Short-term investments such as stocks and bonds purchased when a business has excess cash. Another important group of current assets is trade and other receivables. These are amounts that customer or other parties owe the business. These include account receivable, note receivable, interest receivable, advance employees, and accrued income. Inventories. These are unsold goods of the business that are intended to be sold in the normal course of operations. Prepaid expenses. These are the expenses paid in advance for supplies or services that the business will use in the future. Contra assets. These are accounts that reduce the value of related assets and show deductions such as depreciation or uncollectible amounts. Accumulated depreciation, the total amount of an asset cost that has been expensed over time. Allowance for bad debts. These are the estimated amount of receivables that may not be collected from customers. These assets are important because they support the daily operations of the business and provide liquidity.
Now let's move to non-current assets. These are assets expected to be used for more than 1 year and are not intended to be sold immediately. Compared to current assets, non-current assets are used for the long term and are not easily converted into cash. While current assets support daily operations, non-current assets help the business operate, expand, and grow over time. Although they are less liquid, non-current assets contribute to the business' long-term growth and stability. One type of non-current asset is long-term investments. These are investments held for a long period to earn interest, dividends, rentals, or to increase in value over time. Another major group of non-current asset is property, plant, and equipment. These are tangible assets used in business operations. Examples include land, buildings, equipment, and furniture and fixtures. These assets are not bought for resale, but are used to help the business produce goods, deliver services, and operate efficiently. Non-current assets may also include intangible assets, which have no physical form but are valuable to the business. Examples are goodwill, patents, copyrights, trademarks, and franchises.
The two forms of the Statement of Financial Position. There are two common ways to present the balance sheet. Firstly, we have the account form. In this format, the balance sheet is arranged like a T account. Assets are listed on the left side, while liabilities and owner's equity are placed on the right side. This layout visually emphasizes the balance between what the company owns and how those assets are financed. For the second format, we have the report form. In here, the balance sheet is presented in a single vertical column. It is often considered easier to read because it flows in a straightforward sequence, because we list down the assets first, second the liabilities, and lastly the owner's equity. Steps to prepare the account form. First is we classify the assets. We list down the current assets first then followed by the non-current assets. We then add them together to get the total assets. Second is we classify the liabilities. We list down the current liabilities and then followed by the list of the non-current liabilities. Then we add them together to get the total liabilities. Afterwards, we also add the owner's equity. To do the final check, to ensure that they are balanced, we have to follow the accounting equation, wherein the total assets is equal to the total liabilities plus the owner's equity. Steps to prepare the report form. First is we have to list the assets. We have to classify first the current assets and then proceed to classify the non-current assets, and afterwards, we total them. Second is we have to list the liabilities. We also have to classify the current liabilities and then proceed to classify the non-current liabilities, and then we total them. Lastly, we have to add the owner's equity. To do the final check, we have to utilize again the fundamental accounting equation, wherein the total assets is equal to the total liabilities plus the owner's equity. We learned that there are two ways to present the balance sheet: an account form that looks like a T account with assets on the left and liabilities plus owner's equity on the right, and the report form, a straight column format with assets first, then liabilities, then owner's equity. Again, the report form is usually easier to read, but both forms show the same information. So remember, the key is to classify accounts correctly and check that the total assets is equals to the total liabilities plus the total owner's equity. Thank you for watching, and I hope this lesson helps you understand the balance sheet better.